Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Pyramid Technoplast Ltd. So it is an industrial packaging company that manufactures polymer-based molded products. It specializes in rigid intermediate bulk containers, IBCs, polymer drums, and mild steel drums used by the chemical, agrochemical, specialty chemical, and pharmaceutical industries. Now, coming to their business at a glance, they have a presence of more than 26 years and they have a production capacity of 63,293 million tons per annum, which is continuously increasing because of their current capex. They have got pan-India presence with 8 manufacturing facilities and have got 500 plus satisfied customers with a fleet of 84 trucks. And they have shown a revenue CAGR of 17% in the last 5 years. Now, the company operates across 7 manufacturing units with capacities of 27,000 million tons per annum for polymer drums, 420,000 units for IBCs, and 10,800 MTPA for mild steel drums. And they're commissioning their Unit 8, which is in Wardha, Maharashtra, which is a significant shift from their Gujarat-based concentration. So they have got a diverse and superior customer base with top clients being Adani Wilmar, Asian Paints, Patanjali, JSW and Deepak Nitrite among others, and have got a very excellent experienced leadership team with Mr. Bijay Kumar Agarwal as the managing director and chairman and his son Mr. Jay Prakash Agarwal as their full-time director and CFO. All of them have got very good industry experience and have a lot of skin in the game. Coming to their business model, so they're focused on operational efficiency and modular capacity additions. The company is well positioned to scale profitability in current context. They already had a very strong presence in Gujarat in the past, and they are expanding their production capacity across all drum categories in Maharashtra, which is strategically located near industrial hubs. And combined with their in-house fleet of 84 trucks, they have ensured timely deliveries, cost efficiency, and also a strong customer connect. Also, they are backward integrating in-house manufacturing of caps, leads, and handles for cost control and quality efficiency. So we'll discuss the Wardha expansion in the next slide. So they have also set up a Unit 9, which is a recycling plant, which is expected to begin operations in July-August 2025. They have done a capex of 8 to 10 crore rupees, and the plant will recycle 5,000 metric tons of plastic annually, reducing raw material costs and dependency on imports. Now coming to the Wardha Maharashtra plant, so it's a new avenue of growth for the company to tap new customer base in Maharashtra. That unit has a large land of 10 acres and first phase is nearly complete, which has a revenue potential of around 200 crores and full potential revenue is expected to exceed 400 crores, which will be realized over the next 2 phases in the next 3 to 4 years. Now, the strategic rationale behind it was to facilitate capacity-led growth, specifically in the IBC segment, which is their high-margin business. And they're also focusing on geographic diversification because they already were concentrated in Gujarat itself. And we had already mentioned that they wanted to expand their client location. They wanted to expand to Mumbai so that they are close to their client locations. Now, their operations are set to commence with phase 1, where they would manufacture HPDE, IBCs, and metal drums in the new unit. And overall, for FY26, these capacities are likely to average 30% capacity utilization. Some of the key strengths of the company include experienced promoter and leadership team, diverse customer base, quality standards, certification, and quality tests, and strategic location of manufacturing units. And adding to that, they already have got a very comprehensive product portfolio. For IBC containers, they are the leading manufacturer and they are specializing in the production of 1000 liter capacity IBCs, and they leverage significantly due to logistic and handling timelines, improved efficiencies and increased capacities by enabling the filling, moving, loading, transit and dispensing of materials in a single container. So all of this is going to benefit their customers. Coming to the plastic barrels, so they are manufacturing a wide range of plastic barrels which are supplied to chemical, agrochemical and specialty chemical and pharmaceutical companies. They range from 20 liter to 250 liter containers and are even higher according to clients specifications. Then they have the mild steel drums, where they manufacture a wide range of drums such as general purpose metal drums, epoxy coated lacquered drums, composite drums, galvanized drums, and open top drums. So all of this is composes their product portfolio. Now coming to their state of the art manufacturing facilities, so they've got 7 units which are operating at a very high operational efficiency. All of them are based in Gujarat, and they have also two more plants which are commencing operations very soon. Coming to the revenue breakup, so as we can see that right now in FY25, 44% of the revenue comes from polymer drums, 34% from IBCs, and 11% from mild steel drums. Also, they have got another 11% which is getting added by other operating income. So the given graph shows that they are like with throughout the years, the polymer drums concentration has reduced, and the company is expanding the IBC's revenue contribution in the total revenue, which is good because IBC is their high margin segment. Coming to the capex upgrade, so in Unit 6, they increased their capacity from 50,000 units to 90,000 units, which are and trial runs are ongoing in June 2025, and commercial output will start by September 2025, and margins are expected to benefit from this operating leverage. In Unit 7, they have the second IBC line commissioned, with their first line commissioned in September 2023 at 60% utilization. And here they're manufacturing HDPE, which is high density polyethylene products, along across 4 HDPE drum lines, 3 into 200 liters and 1 into 50 liters. In Unit 8, Maharashtra, which is the new unit outside Gujarat, so their phase 1 operations commenced with 1 IBC line, 2 HPDE drum lines, and 30K per month in MS drums capacity. And trial runs have been completed, and commercial production is set for Q1 FY26. Coming to the Unit 9, which is the recycling unit. So it was a land adjacent to the Unit 6 in Gujarat, and they have acquired it for establishing a plastic and plastic products recycling plant. And construction has been completed, and operations are expected to commence from July-August 2025. And they're expecting a payback period there of around 2.5 to 3 years. So regarding the outlook, they're expected to do further 50 to 60 crores worth of capex for the next 2 years. And this investment will support the upcoming Maharashtra unit and expansion of Unit 6 and Unit 7, and the development of a 50 crore captive solar power facilities. Also, to fund capex, they're using internal accruals and cash balances from the balance sheet, and marginal increase in debt due to captive solar power plant capex. Also, their greater revenue share of high margin product like IBC and increasing automation and capacity in metal drum production, along with optimizing production at each site, is going to further enhance their revenues and margins. Coming to the financial overview, so as we can see, the management has mentioned that the margin contraction in Q4 FY25 was due to bunching of cost. EPL liability of 1.5 crore for the year was booked this quarter itself, and going forward it would reduce. And some of the transportation costs also for the previous quarter got booked in the Q4. So the company is going to work on this. Also, with the ongoing capacity expansion and product shift to IBCs, which contributes 37% of their revenue, and expanding their growth observed in other time categories as well. So the company is expected to significantly benefit in the future. Coming to the financial highlights, so year-on-year revenue has been growing well nicely, and EBITDA margins took a hit in the past 2 years. So has been for the PAT margins, and As we can see, the management has significantly highlighted the fact that in FY24, they have been impacted due to sharp and continuous fall in raw material prices, while cost lagged selling prices. So this also led to increase in cost due to Unit 7 commissioning. Coming to the operational performance, so revenue wise, the company has been doing good across all the segments, and also in volume wise, we can see that the polymer drums and MS drums have been growing at a very steady pace. But the IBC business has been growing significantly well in terms of volumes, and the capacity utilization for the firm has also been steady. However, it has declined a bit due to new capex and currently stands at 69.5% of total capacity. The net debt to equity ratio was zero in FY24. However, this year they have taken a bit of a depth, and the management mentioned it was for the purpose of working capital requirements. And so, because of this, the interest coverage ratio has also declined a bit. However, it's still very high. Their current ratio is good, and fixed asset turnover is also declined a bit because of the newly added capex. Their working capital cycle is decent. And coming to the strategic roadmap, so they are expected to increase their HDPE drums capacity by 20% this year, IBC drums capacity by 29%, and mild steel drums capacity by 55%. And all of this would add a top line growth of 15 to 20%. And regarding their margin expansion, so in power costs, they have planned a cost reduction of 10 crores per year, which is expected to begin operations from July 2025, and this would improve their cost efficiency. Also, raw material cost is expected to reduce because of their 5,000 ton recycled plastic, which would be done in house, and 30,000 tons of HDPE, which is currently used for production. So all of this is expected to lead to operational cost reduction. And also they're focusing on economies of scale by automation. 90% of the automation has been accomplished by replacing manual processes with process control systems in existing and upcoming facilities, and reduction in manpower, improved production efficiency, and MS drum margin expansion to 8 to 9% is expected to reflect in the EBITDA margins of 11 to 12%, which is a significant improvement for in the past 2 years. Coming to the con call highlights, so the company recorded a 16% year-on-year volume growth in FY25, with strong growth across MS drums of 35% year-on-year, HDPE drums of 11% year-on-year, and IBCs of 44% year-on-year. MS drum automation reached 90% and is expected to improve margins significantly. The second IBC line has been commissioned, and the first line is at 60% utilization. An expansion is set to meet growing demand for IBCs. Also, the Unit 6 MS drum capacity expanded from 50 to 90,000 units, which we already discussed, and their 15.25 megawatt solar project is under implementation and will reduce power cost by 10% and would improve their margins. So the commercial operations at Wardha Unit 8 is expected to contribute 70 to 100 crore revenue in FY26 with 200 to 400 crore potential. And overall capacity utilization across all the units is currently at 70%. And Unit 8 is expected to reach 30% this year. They're targeting EBITDA margin of 10% plus in FY26, which we already discussed. And the working capital debt is expected to be 100 crores with finance cost guided at 6.5 to 7 crores. Coming to the bull case, full scale of operations are at Unit 8 and recycling plant at Unit 9 can unlock 400 crores of in incremental revenue over 3 to 4 years. EBITDA margins are expected to improve from 7.9% this year to 10% plus in FY26, which is good for the company. Also, product mix shift towards high margin IBCs, which now contribute 37%, is quite good for the company. And growing demand from pharma, agrochemicals, and chemical industries can support multi-year structural demand for industrial packaging. And their entry into Maharashtra expands their reach and reduces dependency on Gujarat. And also, strategic locations offer them a logistic edge and strengthen their customer relationships. Coming to the bear case regarding what can go wrong. So, delay or suboptimal utilization at the new units could push back revenues and margin expansion plans. And growth strategy is highly capex driven. So, any delay in the payback or underutilization may affect the ROC and shareholder returns in the near term. IBC exports form a very small portion of revenue, around 20 to 22 crores in FY25. So the company is not exploring its full export potential, while domestic growth may saturate over time. So that's something the company should work on. Also, working capital is expected to rise with revenue growth, which can lead to EPS dilution in future. And the company does not have pricing power. Market pricing is demand and supply driven, so realization pressures may persist due to increasing competition and lack of differentiated pricing ability. Coming to the 20 factor scorecard, the company came up with their IPO in 2023 with a total size of 153 crores. It was a fresh issue of 91 crores and OFS of 61.75 crores. Out of the 91 crores of fresh issue, they used 40 crores for repayment of borrowings, 40 crores for working capital requirements, and 5 crores for general corporate purposes. Since they used it mainly for repaying borrowings and working capital requirements, I'm going to give them a 3 out of 5 here. Regarding director and promoter track record, they already have a very good track record, which we already discussed. So I'm going to give them a 5 out of 5 here. And Agarwal family also holds 75% of the company. And regarding related party transactions, they are negligible. They're not even 0.1% of the total revenue. So I'm going to give them a 5 here. Regarding board independence and composition, so they've got 6 directors, out of which 3 are independent directors and 3 family on board, with 50% independent director representation and 50% family representation. So I'm going to give them a 5 out of 5 here because there is a very good balance. Also, CEO and key managerial personnel salary is just 0.2% of sales, which is quite good. So I'm going to give them a 5 here. Regarding key person resignation, so the company secretary and compliance auditor resigned in 2025, and the last company secretary and compliance officer also resigned in 2024 due to personal reasons. Also, the independent director resigned in 2023, and the co-promoter of the company, Pushpa Devi Agarwal, resigned in 2023. On account of this, I'm going to give them a 3 out of 5 here pessimistically. Coming to the auditor tenure, they have the tenure till 2026. So I'm going to give them a 5 out of 5 here. Auditor opinion has been unmodified over the years, and they've got a very good long-term and short-term rating of acute A minus and acute A2 plus respectively. So I'm going to give them a 5 here. Regarding regulatory or legal issue, nothing could be found against them. So I'm going to give them a 5 here. And investor communications or disclosures are very nicely provided. So I'm going to give them a 5 out of 5 here. Coming to their business concentration risk, so top 5%, top 5 customers and top 10 customers contributed a very low share as per their RHP filed in 2023. Top 5 customers contributed around 19% and top 10 contributed 27%. And the company has got a very diverse and superior customer base of top MNCs, which we already discussed. Also, the revenue breakup is quite diverse and they've got 500 plus customers. So I'm going to give them a 5 out of 5 here. Regarding CFO by EBITDA, so this year they have shown a significant improvement and they have significantly reduced receivables and inventory value. However, the numbers were pretty shaky last year. It was a CFO by EBITDA was minus 8% due to high receivables and inventory. However, since the company has shown significant improvement, I'm going to give them a 5 out of 5 here. Regarding revenue growth versus receivables, receivables have been growing at a much higher pace as compared to the revenues, and receivables as a percentage of revenue has been 19.5%, which increased from 16% in March 2023. And DSO has also been increasing for the past 3 years. On account of this, I'm going to rate them a 3 out of 5 here. In inventory trends, inventory turnover ratio is 8, which is quite high, and inventory days are at 49. They have improved a bit in the past 4-5 years. However, it's not very high, and inventory growth is just 3.7%, with inventory covering 10% of revenue. So I'm going to give them a 5 out of 5 here. Cash conversion cycle is decent. It's around 79. However, it has been increasing significantly over the past 5 years. So I'm going to give them a 3 here pessimistically. Also, capex as a percentage of revenue is 11%, with fixed asset turnover at around 6 and asset turnover at around 1.8, and a return on invested capital of 13. So I'm going to give them a 5 out of 5 here. However, it is to be noted that return on invested capital has significantly reduced over the years because of additional capex. Debt to equity ratio is quite good. It's around 0.2 and interest coverage is 14.4. So I'm going to give them a 5 out of 5 here. Quick ratio and current ratio stands good, so I'm going to give them a 5 here. Regarding return on equity, return on capital employed, and return on asset, the numbers are quite decent. It's around 11%, 14%, and 7% respectively. However, they have taken a significant hit in the past 4 or 5 years. So I'm going to pessimistically rate them a 3 here. And regarding growth consistency, so revenue has been growing well at an average of 18%. However, PAT growth took a big hit in the past 2 years because of the operational challenges which the company was facing. So, on of this, backward looking, I'm going to give them a 3 out of 5 here. This makes the total score in governance and promoter behavior 46 out of 50, and in financial health 42 out of 50, taking their total score to 88 out of 100. Now coming to the valuation analysis.
So, a very good corporate governance for a very small company, microcap. This is what we like. Only thing is, it's not a very high moat business. It's more of a
Yeah, they don't have pricing power.
yeah, they don't have pricing power. It's more of a demand supply game and operational efficiency game. However, management looks very clean and new capex have come into play. So definitely worth a watch. I would not have a very extremely long time frame, but a shorter time frame to play the capacity utilization game they have done on. Current P is 22.4. However, this looking because their margins were low for the last couple of quarters. They used to do 10, 11, 12. The management is saying that this is the lowest they can go, and a lot of manufacturing or new capacity expenses were included, and that's what is driving the margins low and should come back to normal levels of 10 to 8%. However, let's be conservative and take 7.5 for our worst case. They are guiding 15 to 20% revenue growth. So 673 worst case looks, let's go with that number. And yeah, an 18.5, the price target comes to 162. The current price is 160. But if they are doing on the higher end, which is the best case, now coming to operating free cash flow, they have done huge capex. So take a bit longer, 3 to 5 years time frame. So let's see what happens when we have a 5 year time frame. So since the free cash flow is negative, they have done 27 crores of net profit last year, and the operating cash flow operating this one is 35. So let's take a lower number to be conservative. Let's take the earnings to be 27, and the required rate of return is 20, terminal growth rate of 3, and holding period of 5 years, and terminal 5 year multiple is 16. The implied earning growth rate has to be 21% from the current levels. Margin expansion can amplify this earnings growth rate and PAT growth rate. So that is one thing that has to be considered, not just the top line growth rate. The management has just guided for the top line growth rate, but then when operating level plays in, then this earnings growth rate grows much faster. That is point number one. And point number two is the new capex that is coming into play. So keep an eye on that as well. So looks like reasonably priced if your return expectations are at 20%, maybe a bit more of a corrections, then you could start accumulating it. Let's see what happens. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing, and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.